Good evening and welcome to our big copper evening. I was quite impressed. I think that's the first time that the crowd has actually quietened itself down. You know, normally I've got to put the fire hose on you guys. It's nice, how civilised. But anyway, it's good to have a buzz in the room. Always nice to be back together to learn more about our mighty industry. So a very warm welcome from also from our patron Trevor Sykes, who we haven't seen for some time, but we always think of. Dear fellow, just want to run through the sponsors and thank them all, as I always do. And as I run through them, just remember to thank them. They actually, the reason that there's no membership fee at the Sydney Mining Club is because it's the funding that comes from the sponsors. New South Wales Mining Council, which has been a long time supporter. APM Graphics, CRE, the insurance company, mining insurance up there. The boys are here tonight. Insure your D10 for you. Research as a Service, Fiona Finola Burke's outfit. CRU. What's that other one around there, boys? What's that last poster up there so I can't see it on my end? Just read it out. Have a look. New South Wales Mining. At this end. RFC Ambrian, the funding, the venture capital outfit. Major sponsors, of course, are Bear Dole Bear and AME Group, do a great job and have really anchor the organisation wonderfully. And I can't see that first one there. Veritas, a great broking firm here in Forster tonight. AMEC, which is for the Lucy's here from the Australian Association of Mining and Exploration Companies. Ioneer, the mighty lithium company exploring and developing in Nevada in the US. Thiess, a relatively newcomer, the big, great Queensland name and international name in mining contracting. Fender Geophysics, Andrew Sleuth, and Taurus Funds Management, also Sydney venture capitalists, so big fund outfit. So whenever you see anyone from those companies, please thank them in person and better still give them your business. A couple of things to get through. Batting order, we're going to go, as you see it on the screen up there, and I'll get the speakers up in a moment to join us on the stage. I've been absent for a while up in far north Queensland on these evenings and lunches, building a project up there. It's a bit hard being stretched between far north Queensland and New South Wales, but I really do, as you know, I really enjoy doing this role. And one of the things I really enjoy about it is giving some commentary about the things that are on front of mind for many of our industry. And just want to open, I've got a few slides here. You see the Fair Australia. This is an organisation run by Jacinta Price, and it's her. She's speaking in support of the no vote for the voice. In my view, the dogs are pissing on our swag with this voice. There is, but I just want to show you something in here. This is a little insight in here that came up in one of the videos. But if you want, Andrew, would you mind just kicking that along, please? So that's Jacinta and her mother there from Alice Springs. She's now a senator. Next slide. So you see this guy at the back here, Thomas Mayer, with a shell around his neck. Looks like a sweet fellow. He's always there representing the voice. You notice him; he's always present, right? Next slide. He's got a book on the voice. And next slide. And that's his name, worth remembering, because as we go on, we learn more about him in this little video. Next slide. You'll see he actually, if you look on his sleeve, you'll see that he's from the MUA. Well, that kind of surprised me, I've got to say. Next slide. The Maritime Union of Australia, which is one of the most powerful and militant unions that there is. So there's a bit of a crossover going on here.
He's got the same shell around his neck too.
There you go, it's the same bloke. Next slide. So this is, hey, if you look at this video, you can look it up, get on Fair Australia. You can send them money if you want to support them. But there is some very strong statements coming from this guy, and he's grateful makes verbal thanks to the Communist Party, and has some very surprising values. Next slide. And he really just sees this as the first step, reparations, compensation. It's actually, and he spells it all out there. And this is the guy standing behind Albo. Now, at the beginning of the State of Origin, they had a yes vote promo, and I figured at the beginning of a mining event like this, where we do more for the employment of Aboriginal people than any industry in Australia, and have a lot to be proud of in the way we work with traditional owners, I thought it was pretty good to get up and give these guys a plug for the no, because we're not getting the equal opportunity to do that. I think it might be the last one. Was that the last one, Andrew? Oh, right, here we go. This is the next subject. So that was just a little bit. Look it up, Fair Australia. You can go and search Thomas Mayo and learn all about the connection of the voice to the big boys in the union industry. So, imagine that. You've voted into your constitution, and which hand is in which puppet. There's one hand in one puppet, and there's another hand up in that puppet. So if that hasn't got whiskers on it, I don't know what has. So, all right, so that's a bit of current affairs for you, and a little bit of opinion thrown in. Quite a lot of opinion. But, anyway, it blows me away. I really hope it goes down. Now, this is a little promo for, this is what a modern geologist looks like. This box does everything. It XRF analyses, it does spectral work, it photographs, it does the full suite of analysis, and it comes from our mates at Phoenix Mining Technologies, and it's just one quite interesting. They're using it, where it is hard to get geologists, it's particularly useful. They're using it at Xanadu mines in Mongolia, and they said here, every stick of core coming out of 6 rigs on site is being run through these box scans, as they're called. This data is critical to developing an actual geological, geometallurgical and geotechnical model to feed into the current PFS process. We couldn't do that if we were using without doing the box scan. So how cool is that? It's being used across Australia in different mines that are listed here. You can have a look at it in your own time if you want to, but hell of a device, and it just shows you how, because I don't know, I've logged a lot of core, and sometimes you're just looking at it and going, come on, Lord, send me an adjective. How do I describe this rock? Well, we're getting the data and the assays and the whole information sucked out of every stick of core. So it's a pretty exciting way to look at look at your data afterwards and try and vector in on your discovery. So that's a little thing of interest. Future Mining magazines are here. So that's our exclusive magazine that publishes all the proceedings of the Sydney Mining Club. And in order, I think gentlemen, would you like to all come and join me on the stage up here, and we'll get running. We've got 15 minutes, 20 minutes apiece. They're all good for self-management on time, so I don't have to do anything except sit back and with great interest and enjoy the stories and decide which stocks I'm going to buy. So enjoy the presentations, and please join me first in welcoming Mike Haynes and the New World Resources story to the stage. Please put your hands together. Oh, well, mate, that's broken hands. Glad I didn't shake that.
Excellent. Thanks very much, Julian. It's my first time at the Sydney Mining Club, but it's fantastic to see such a great turnout. So to all of you, I really appreciate the opportunity to be here and for you guys attending tonight. I'm not going to talk about the fundamentals for copper. I think we all understand that copper is an integral part of the electrification of the world. What I want to focus on is our project Our project is one of the highest grade copper deposits in the world. Indeed, Paul Howard, analyst at Canaccord, regards our deposit on a copper equivalent basis as the 30th highest grade copper deposit in the world. Over the course of the last 3 years, we've delineated a critical mass to mine, and we are firmly taking our project to production, and the opportunity to develop this project is extremely financially robust. Our project's located up in northwestern Arizona. It is a fantastic place to be doing business. It is very sparsely populated where we are, but we are only 15 kilometres from an interstate highway, 15 kilometres from transcontinental rail, and 55 kilometres from a town of 30,000 people. So we couldn't be in a better location. And as you can see from this photo, there's historic mining here. The Antler deposit was last mined in 1970, and the most recent exploration prior to our involvement 3 years ago was done in 1975. Mineralisation has been delineated over 600 metres of strike, and we have, over the course of the last 3 years, drilled out a very sizable resource. Just corporately, before I get into the fundamentals of the project, then I note that our market cap is $70 million, share price of about 3.3 cents. But I do note in our share price chart that back in early 2021, when copper price ran from $7,500 up to over $10,500 a tonne, then in the space of less than 2.5 months, our share price went from 4 cents to over 12 cents. So that happened really, really quickly. Since then, we have declared a maiden resource. Since then, we've updated our resource. Since then, we have done 2 scoping studies. We've defined that we've got a viable mining proposition. We continue to have a huge exploration upside, and we're building a team to mine this project. Our team includes Richard Hill, who's our chairman. He's a geologist and a lawyer, but have been heavily involved in corporate finance for the last 20 years and project finance for mining projects. Tony Polglaze, his last role was as a managing director of Vanco Resources. His full-time role there took an exploration play in Brazil, a copper development proposition, through exploration success, through permitting, through financing, into production, and that was taken over by Oz Minerals. Tony's a metallurgist by training and also an electrical engineer. And recently we've appointed Nick Woolrich, he's Sydney-based. Some of you will know Nick. Nick is a mining engineer. Nick has been intimately involved in the studies that we've been undertaking into the development of our project, and Nick is helping us to not only bring the project back into production, but also to build out our team. We're set for success. We have so many favourable attributes that put New World in the position to not only develop this project, but also to have further exploration success and to continue to realise value for shareholders. We've got so many favourable attributes, so I can't list them all here, but jurisdiction is critical. Without a good jurisdiction, then it's very, very difficult to develop a project. The grade of our deposit is 30th highest grade deposit in the world, copper deposit. Very modest capex because of that high grade, very high margin because of that high grade. Long life, we've got 13 years of mine life ahead of us, and we're near-term production. We're submitting mine permit applications in the coming months. There remains considerable exploration potential. I'll touch on this as we go through the presentation. Deepest holes on the project has intersected 21.5 metres at 5.3% copper equivalent. That's 850 metres below surface. We're still just scratching the surface, and we're heavily undervalued. So our strategy is to get Antler into production, but equally we are going to continue to grow the resource base. In terms of jurisdiction, 70% of the copper that is mined in in the US, comes from the state of Arizona. It is very pro-mining. Indeed, where we're located, then we're located 40 kilometres away from the Moss mine. In 2020, the Moss mine was permitted as an open pit heap leach gold operation using cyanide. That permitting took 18 months. We're looking at an underground only dry stack tailings facility, no cyanide, returning 50% of our waste product underground. So we expect streamlined mine permitting. Arizona is ranked 7th in the Fraser Institute, and significantly to get our project into production, then we're on privately owned land, and so almost all of our permitting is overseen by the state of Arizona, and the state of Arizona has the longest lead time for its permits of 15 months. Just honing in a little bit on the project in detail, then Antler is located 15 kilometres from Interstate Highway and Transcontinental Rail. We've got mains power to within 750 metres of the old headframe, and we're 55 kilometres from 30,000 people. What's this mean? It means it'll be quick to build, it'll be low cost to build, and it'll be low cost to operate because we've got access to that infrastructure. It reduces capital cost and it reduces operating costs. Over the course of the last 3 years, so from March 2020, so just a couple of weeks before COVID hit the world, then we started drilling on the project. And for 3 years, non-stop, we drilled at the project with up to 3 rigs on site. We declared an interim resource in late 2021, which was 7.7 million tonnes, but the mineralisation remained open at depth, so we continued to drill deeper and deeper. And by November 2022, we declared a updated resource of 11.4 million tonnes at 4.1% copper equivalent. So that's about 2% copper and 5% zinc. And on a metallurgically recovered basis, that translates to 4.1% copper equivalent. But if we took 100% of the metals in that resource, then it would report as 4.7% copper equivalent. So 11.4 million tonnes at 4.7% copper equivalent. There's a lot of margin to be had in that. 79% of that resource base is classified indicated. Very high confidence level in that resource. What's more, if we apply a 2% copper equivalent cutoff, so if we eliminate all mineralisation that is below 2% copper equivalent in grade, and we only contemplate mineralisation that's higher grade than 2% copper equivalent, then we still have 9.8 million tonnes at 4.5% copper equivalent on a metallurgically recovered basis. So that'd be 9.8 over 5% copper equivalent. What that says is that no matter what the copper price environment is, we are highly likely to have a viable mining proposition. And I'll outline some potential economics as we go deeper and deeper into this. In terms of our development approach, we've taken that 11.4 million tonne resource and we've done a mine design on it. Deliberately, we are looking at a low impact mining operation. Low surface impact and minimising impact on the surrounding environment and on the very limited surrounding population. So between our project and the town of Yucca, 15 kilometres away, we go past 8 dwellings on the road. This is very, very sparsely populated. 4 of those dwellings are off the grid, so there's no power, no running water. And those people do not want to be seen. So we are in a very sparsely populated area, but notwithstanding that, we are still going to apply best practice. We could have a starter open pit. Mineralisation comes to surface here. But deliberately, to minimise impact, then we are going to go underground only. We're going to use dry stack tailings, which is best practice in the US, probably arguably the best practice in the world. We're going to return at least 50%, maybe as much as 60% of our waste product back underground as paste fill. So this is going to be a very, very low impact proposition. And because of the grade, then we're not moving many tonnes. The emissions that are entailed with moving such high grade material is not comparable with the large open pit mining operations. This is all going to help us streamline permitting. In terms of mining, of that 11.4 million tonnes, then 10.6 or 93% fall into the mining inventory. That's an extraordinarily high conversion rate. Normally people see 50, 60% of their resource base converting to reserves. Essentially our mining inventory is reserves. So because of the grade, because of the lateral continuity, because of the thickness of the mineralisation, because of the vertical continuity of the ore deposit, we have to this point just drilled a single pod of mineralisation that's 550 metres long and 850 metres high, up to 40 metres thick with some of these stopes. Then because of that continuity, then we get a very high conversion rate of resources to mining inventory, and ultimately it'll be resources to reserves. So despite us only having 11.4 million tonnes, we see 15.5 million tonnes mined. And that's because of planned dilution. In order to efficiently recover that 10.6 million tonnes of mineable mineralisation, then we are taking out around 4.5 million tonnes of planned dilution. That sees us delivering on a diluted grade basis 3% copper equivalent ore to the mill. So that's our starting point. And we see that with our mine design, we can have steady state production of around 1.3 million tonnes per annum for 10 years. So there's a quick ramp up and a bit of a tail. But as I say, exploration is ongoing and we are extremely confident that we will continue to extend the life of the mine. So the metrics of that see us deliver, over the life of that initial 13-year operating period, 380,000 tonnes of copper equivalent metal, half of which is contained copper. And on an annual basis, 33,000 tonnes of copper equivalent metal, 16,500 tonnes of copper in concentrate. To do so, we forecast mining costs of around $76 a tonne US. That's mining, processing and G&A. We include, unlike a lot of people with the scoping studies, we include transport and TCs, RCs, $16 a tonne. That brings our total cash cost to $92 a tonne, US dollars. And with all-in sustaining costs, that bumps up to $96 a tonne. Each tonne of ore that is delivered to the mill will return us $194 a tonne. This is assuming a $3.85 copper price, $8,500 a tonne. A lot of you in this room would believe copper price is going a lot higher than $8,500 a tonne. Indeed, it was only 2 years ago that copper price was over $10,500 a tonne. So the economics are even better if copper price goes up. But even if copper price is low, then we have a very viable mining proposition, because our cash costs for copper production are negative 50 cents a pound, or for each of those 16,000 tonnes of copper that we produce each year, the cash costs are negative $1,100 a tonne. In order to develop that, we see we've got a capex of about $250 million US dollars. For that capex, we have anticipated building a processing plant that's around 1.5 million tonne per annum capacity, despite our steady state production of 1.3 million tonnes, because we see that we are highly likely to have exploration success over the coming years, and hence when that processing plant is built, we would like to have additional capacity. And I note that with that, then that $252 million estimate for capex, then we are including $44 million US dollars for contingency. So we're being conservative on these things. And there's an additional $70 million of sustaining capex. So what's that mean for the operation? Over the life of the mine, just this starter 13-year mine life that we are forecasting, we see that we will generate $4.3 billion Australian of revenue, or $3 billion US dollars. And half of that, after capex, so after pre-production capital plus sustaining capital, then half of that is free cash flow. So 1.5 billion US dollars of free cash over that 13-year operating period, or over 2.1 billion Aussie dollars. And on an annual basis, over 150 million US dollars of free cash each year, or over 210 million Aussie dollars free cash each year. This is for a market cap of 70 million Aussie dollars. I think we're highly undervalued. And if we discount that, then the NPV of the project's 835 million US dollars. Very, very robust IRR, and there's plenty of interest in funding the development of this project. But what have we got? Well, this diagram actually illustrates the only drilling that New World has done in the last 3 years. Our drilling is entirely constrained to 600 metres of strike, down to a maximum vertical depth of 850 vertical metres. Through the course of the last 3 years, we have progressively gone deeper and deeper and found thicker and thicker mineralisation, and the mineralisation is always high grade. So this diagram is actually combining thickness of mineralisation multiplied by grade. So to be greater than 10 copper percent metres, or copper equivalent percent metres, we colour it up as yellow. So that'd be 5 metres at 2% copper equivalent, very, very mineable. Greater than 20 is coloured as orange. Greater than 40 is coloured in red, and greater than 60 is coloured in magenta. So 60 copper percent metres would be 15 metres at 4%, or 10 metres at 6% copper equivalent on a metallurgically recovered basis. It has to be that just to fall into the magenta category. So we see two very strong, robust corridors. They're shoots, they're plunging shoots, structurally controlled plunging shoots of thick, high-grade mineralisation that extend underneath the old workings. With some of the intercepts in more recent drilling, we've now drilled 58,000 metres, and more recently, over the last 12 months, we've intersected zones including 42 metres at 3.8 copper equivalent. And as I mentioned, the deepest hole on the project is intersected 21.5 metres at 5.3% copper equivalent. So almost certainly there is additional mineralisation deeper below that intercept. And just adjoining that in the south shoot, there's an intersect in the deepest hole in the south shoot of 10.7 at 13.7% copper equivalent. It's exceptionally continuous. 94% of our holes have intersected high-grade massive sulphide mineralisation, and every single hole that we've drilled is illustrated on this diagram. So to date, we've only drilled over 600 metres of strike. But this deposit is one of two known deposits within VMS deposits within six kilometres of each other. And indeed, we have a much larger land holding. So the second deposit, down in the bottom left-hand corner, is the Antler deposit, and the blue ellipse illustrates where we've drilled, the 600 metres of strike that we've drilled to date. That blue ellipse is superimposed on a copper in soil geochemistry anomaly. And we see that blue ellipse sits on a 1.5 kilometre long copper in soil geochemistry anomaly. And indeed, that copper in soil geochemistry anomaly coincides with a strong IP anomaly. And we use that IP response to discover more and more mineralisation. Over the course of the last 12 months, we've started turning our attention to the greater picture, where there's two VMSs, and there is a second one, Copper World, which, for those of you who know Arizona, Hud Bay Resources has a Copper World deposit. It's a porphyry. It's not this Copper World. This is a little VMS deposit. This was Copper World here was also mined in 1970. But where there's two VMSs, it's highly likely there's three. Just like Sandfire had De Grassa, and then they had Monty. And there's other uneconomic VMSs within that belt that Sandfire was exploring. Here we know there's two that were both mined in 1970. We have the same geology between those two, so the same geology extends between Antler and Copper World, and we now have look-alike strong surface geochemistry anomalies and coincident IP anomalies that we will commence drill testing in the coming months. In addition to that, though, we see that we will be building a standalone processing plant at Antler. So any ore that can be trucked to that processing plant as satellite deposits can be highly valuable to us. So deliberately, we are acquiring other opportunities within about 100 k's of Antler. Our first such project is 75 kilometres to the southeast, of what we call the Javelin Project. So the Javelin Project surrounds 6 historic VMS production centres. Of those production centres, the grades average 3.5% copper and 7 to 12% zinc. So an equally high-grade belt of geology. We've acquired 10 kilometres of strike, and we've commenced, in the last 6 months, we've commenced systematic exploration down there. We've got very strong copper in soil, zinc in soil anomalism, gold in soil anomalism, as illustrated here. And just this week, we're finishing up an IP survey that has surveyed the northern half of those strong surface geochemistry anomalies, in expectation that in the coming months we will commence a drilling program down here, because any additional ore that we can discover here can be fed to the centralised processing plant at Antler, 75 kilometres away. This just illustrates some of the strong grades. So where to from here? We've defined a very viable, economically viable, robust resource, very high component indicated resources. We are taking that to production, but we've only just scratched the surface for exploration. So we will continue to explore while we take Antler through permitting and into production. We're halfway through a pre-feasibility study that will be completed at the end of this calendar year. We don't need that pre-feasibility study to apply for mine permits. We're just putting the final touches together with using the scoping study information to apply for mine permits in the coming months, and we will get that mine permitting process underway in September this year. But while we go through that mine permitting process, we'll complete pre-feas at the end of this year. We expect that will roll directly into a definitive feasibility study, completing that towards the end of next calendar year and commencing construction of a decline, so that once the processing plant is built, once we're fully permitted, build the processing plant, we will be delivering high-grade ore to the mill at a rate of around 1.3 million tonnes per annum. With respect to the pre-feasibility study, we've got a huge amount of work underway. We're drilling water wells at present. We've just completed a geotech program. We're drilling holes for surface geotech. We're doing a lot of environmental baseline work, using some of the most reputable consultants in Arizona, and indeed drawing upon Australian expertise, particularly given that we're going to go underground mining. Then we see the Australians are some of the best underground miners in the world, and we want to draw upon that expertise. Thank you.
Righto, pushing straight on. Don't ring your brokers yet. We've got next up. We've got the hot chili peppers. The hot chili story coming from Christian Easterday. Please put your hands together, make him welcome. Good, mate. Good luck.
Thank you. Right. That's just... Well, thank you very much for coming tonight to listen to a nice cross-section of the Australian copper sector. So just some brief comments from myself. I've been in the copper game for quite a while now, since I founded Hot Chili, and we went over to Chile to look for large-scale opportunities in the copper space. And you know, that journey has taken us through the build-out of a discovery and now a regional consolidation play, which has delivered the largest ASX resource in copper. We are currently the largest by resource scale, just sitting under the Tier 1 bracket with nearly 1 billion tonnes on the coastline. But most importantly, last week we were able to deliver for the first time a consolidated hub, PEA, or a scoping study for everything that we've been putting together on the coastline over there. And what that has demonstrated now is that Australia once again has a 100,000 tonne per annum copper player. So most of you are aware that Oz Minerals removal by BHP and the soon-to-be consummated Newcrest takeover has left a vacuum for the Australian sector with copper, which is really something for my heart that sort of hurts a little bit. You know, we're one of the biggest mining countries in the world, and we don't have representation even in the mid-tier space for copper outside of BHP Billiton. So we intend to correct that, and correct that in short order. And what you're about to see is over a decade of commitment, persistence, and consolidation to get ourselves to this point. We're going to be speaking about large-scale copper. This is where 70% of the world's copper comes from. This is a bulks business, very similar to iron ore for the Australian market to understand. And so I think that right now is a really important point in time where we're sitting in front of an inevitable cliff that the world is approaching. We are very, very ambitious. We have very big ambitions for humankind to decarbonise, to approach net zero, to electrify everything, except someone forgot to tell the copper sector that. So we have unrealistic demand put against a supply constraint sector. So we have very few of these large projects available outside of the majors, and even fewer that are able to impact supply before the end of the decade, where this wall of demand is forecast to come. And so I think we're sitting at a point in time where my colleagues would probably certainly agree this is where you want to be positioning if you want to catch the third metal of the 21st century that has got all of the key ingredients to probably 10 bag. And what happens when a commodity multiplies by 10 in price? You see some quite interesting positioning. And we've taken our lessons from the Andrew Forrests of the world in iron ore, I guess an Australian flag waver for iron ore, very low grade deposits up in the Pilbara, $20 a tonne iron ore, very low margin deposits producing very low IRRs, unbackable really. But very interesting when you fast forward about a year and a half into that journey to $200 per tonne iron ore prices. So I've quipped a few times about if you had a time machine, what would you do? If you knew iron ore was going to 10 times, you'd probably be positioning in the ASX company that had the most exposure to iron ore, because that produced intergenerational wealth amongst many Australians that invested in FMG. And so leverage is very easy to understand in this business. If you have one of something and something multiplies by 10, you have 10 of those. If you have 10 of those and it multiplies by 10, I think you can all do the maths. And that's what happened with FMG. It's what happened with Pilbara in front of the lithium re-rate. So what I'm going to show you today now is the largest exposure on the ASX in the producer class, in the developer class, and undoubtedly in the explorer class. And this is something that has not come together overnight. And just through the pure time frames Hot Chili has taken, 15 years into our journey, it's now pretty easy to understand why these big deposits take near on 20 years to go into production. We just have a 15-year head start on any major discovery being made today. So just really focusing on very big news out of Hot Chili last week, which was the delivery of our PEA and putting preliminary economics around this large-scale project. And most importantly also a parallel funding arrangement, which the Australian market hasn't seen for quite some time, and Hot Chili starting to put its asset value to work. And a little bit different to the way that we navigate funding on these projects, and a little bit different in terms of how the equity markets would consider what Hot Chili has just done. So firstly, we're sitting with a top 10 undeveloped copper project as rated by S&P globally, not in Australia. If we have to compare ourselves to the Australian sector, there's a very, very large gap between Hot Chili and the rest of the peers on the Australian market. And we don't have many on the Australian market that have plus 40,000 tonne per annum copper production ambitions. We can count them on a few of our fingers on one hand. So we have about 3.4 million tonnes of contained copper, 3 million ounces of gold, quite a lot of molybdenum and silver. These are polymetallic, large-scale deposits that grade at the average head grade of production globally. The PEA has demonstrated some very robust economics, but what it's really done has outlined now the lowest capital intensity major project in the world outside of a major, and that is because of all the advantages that we have at very low elevation and our ore bodies not requiring desalinated large-scale water supply to process. This can really be considered, as S&P has already done, as one of the lowest risk major projects in the pipeline. So we'll also be talking about the next growth phase, which Hot Chili is very excited. We've taken a deliberate pause to allow ourselves to potentially scale this up towards a 150,000 tonne per annum project. We've just demonstrated the only 100,000 tonne per annum project in the ASX, and one of only 4 globally that sit in this space outside of the majors. And now we're aiming to lift the scale and ultimately to drop our cash costs into the first quartile. Most people would think that the high grade fringe of the copper market would sit in the first quartile. That guess would be wrong. These large scale projects do it through economy of scale. And that is ultimately what Hot Chili has spent 15 years doing. And we believe that the upscale potential on this part of the coastline will enable us to build the largest processing facility and drag out a plus 20-year production profile. So quickly, we'll just look at a few things, and I won't talk about copper or make any further commentary. I think that that most investment analysts around the world can see that copper is the place that you want to be positioning in the coming few years. But we'll talk about Hot Chili's commencement of really a very different way of financing moving forward, not financing against the shares on issue. 18 months ago, we listed onto the TSXV. We dragged our shares back to 120 million shares on issue, and now we start to really drive the leverage equation, and that's all about preserving capital structure through to financing. So after about a year of investigating several different opportunities that were being presented to Hot Chili, we have just executed an investment agreement with one of the largest royalty and streaming houses of North America. Royalty agreements haven't been done in the Australian market for many, many years. And what this has allowed us to do is put a very small incremental royalty on the property, about 1.1% across our payable metals for $15 million US. That'll be closing next week. And really, I guess that contrasts against our market capitalisation of about US 80 million. So very clear see-through value as to what a Cisco has put on this project. And I guess the terms were also very unique. Most royalty agreements in the North American market have an effective production date and penalties thereafter. There's no effective production date on this. It's a pure at-risk investment by a Cisco. And what it means is we've been able to get a Cisco to rubber stamp about a 1.38 billion US valuation on the project and pay us that cash now. So what that has meant is that we have the next 12 to 18 months funded, about 26 million in treasury as of next week once this closes, and that allows us to continue on our very ambitious growth and development plan. Quickly on corporate structure, we have a few endorsements now, one in the North American market with a Cisco, but secondly with our largest shareholder, Glencore, has a 9% stake after a strategic investment about 18 months ago. What we have also is a growing presence in North America, an initial beachhead into the TSXV. We're very much following the pathway that was set by Craig Williams in Equinox when last we had a major copper developer that came out of the ASX. So ultimately this project will be financed in North American markets, as large CapEx projects are almost always funded from that arena. And that North American beachhead, we will start to see increasing liquidity as we move towards project financing. We're expanding our we're expanding our analyst coverage, and most importantly, developing relationships and being exposed to financing optionality, which really doesn't exist in the exploration and development space over in Australia for projects of this type. So location and de-risking sounds like very boring things, and I've been talking about them for a while, but what these have are very direct impacts on your ability to build a mine, and most importantly, drive very low cost CapEx and low operating costs. So we have one of the lowest, if not the lowest, major copper development in the pipeline outside of the majors. We sit on the Chilean coastline, 50 kilometres from port. Most of our peers are in the high Andes at 4,000 metres, and you can see the very big name companies such as Filo Mining, which is actually our neighbour, but just developing at 4,200 metres altitude on the other side of the border. So we're next to the coastline on port and sitting in the middle of infrastructure, and our friends at Filo are in nosebleed country about 1,200 kilometres from the coastline. When we look at the de-risking that Hot Chili is invested in, these are the boring things that people don't start to take notice of until you need them. And water is key to building any mine. And when we look at our peer projects across all of the large-scale space, and we do a lot of benchmarking, and we'll walk through some of that shortly, we talk about meaningful producers at plus 40,000 tonne per annum, just to be meaningful. But on the global copper scale, a plus 100,000 tonne producer is actually meaningful to the copper sector and to global future supply for electrification. And what we found is that Hot Chili is one of the only companies sitting in this space with a water licence. It took us 10 years to get a maritime extraction licence for seawater to operate this project, further 2 years to secure land access on the coast. Last year we were given the last terminal connection to the central grid, sitting 17 kilometres from this hub of projects that lie on the Pan American Highway. All of our easements, our surface rights, and all of that infrastructure is now being leveraged to produce one of the lowest capital intensity projects in the pipeline. And that optionality really in terms of our ability to utilise our precious metal credits for financing, utilise our non-committed offtake rights that we have, but most importantly utilise the assets that we've built here. And water is a big asset, and we'll be talking about that over the next year as we investigate that optionality. But if we move forward, we can now look at the economics of what has just been put to the market. So we have a very healthy post-tax NPV of around 1.1 billion, driving a 21% IRR. The kind of numbers that you would have seen in the iron ore sector before iron ore took off. These numbers dramatically change when you have scale. And so what Hot Chili is offering is not a production base spread out of over 30 years at the moment. It is a production base that has been optimised to 16 years at this point. Probably could go to 22 years if we had have chosen another scenario. But most importantly, this drives 850 million US per annum revenue profiles. And so when you have that, you have very large exposure to the commodity price, which is 85% of our revenue. We are pure play copper. We have very fast paybacks, and we're one of the only large-scale projects that has a profitability index ratio of above 1. So when we look at really where the advantage of this project is, it's in the amount of cash that this throws off. When you're throwing off 95,000 tonnes of copper and 50,000 ounces of gold a year, you're putting out a lot of revenue. Already sitting at $1.33 per pound. So in the second quartile, and with the scale lift, which we're investigating over the next 12 months, that will have us comfortably sitting within the first quartile of global production costs. And this is the leverage ratio that I talk about when we look at 27 bank forecast for copper out to 2027. These are the largest investment banks in the world calling this range that you're seeing there on the right-hand graph. Every 10 cents per pound above the long-term price, which we've used, of $3.85 in line with consensus, adds around 100 million US NPV. Or to put it really simply, if we add 50% to the copper price, and we see that in and around 25 or 26 as we approach financing, that turns this into about a 3.3 billion US project. And trading at ratios of around 0.25 to NPV post-tax, I'm sure you can do the maths on our share price. But I guess that exposure already exposes Hot Chili shareholders to 10 baggers without doing anything. What we're really trying to do now is leverage that equation further by increasing scale. So looking at where this benchmarks, and this is, again, when you're the largest sort of fish in the Australian pond in copper now and Oz Minerals is no longer, then you've got to look to the largest projects in the world, the plus 40,000 tonners. There's not many of them that are advanced. There's a few that in this list that won't be making it into production in 2030. And we look at a measure on capital intensity. So this is the amount of capital required for the amount of metal that this project puts out. As a developer, we are the lowest globally. We've also put a couple of projects that are brownfields that sit next to us in Chile, being developed by Capstone Mining, which is a mid-tier copper producer from North America. But there is no other project that has a lower capital intensity in the pipeline now than Hot Chili's Costa Fuego project. You can see here that all copper projects aren't created equally. We have to navigate both a TSXV regulator and an ASX rate regulator, and we do point out the differences in some of these apples versus oranges. So projects obviously with less than 50% measured and indicated are projects that obviously require a lot more drilling to get that certainty. We sit with about 82% of our resource base in measured and indicated. We've seen a significant investment of around $220 million already into the project. This is your profitability index, your NPV divided by startup capital, a very key index for investment in a major. I used to work with Placer for many years. We wouldn't look at projects that were underneath a ratio of 1. Costa Fuego and Hot Chili's project there is one of only a couple of projects that sit above ratio 1. And this speaks to the margins in the copper business with where the incentive price is at the moment and where it is likely to be if we want any of these projects actually impacting supply by 2030. If they don't, it's going to be, a very, very difficult time for the world's ambitions on net zero. In terms of the top 20 undeveloped projects of the world, and we're very proud to wave the Australian flag. There aren't many Australians in this list. We don't play in big copper because we don't have it. So you have to go to places where 43% of the world's copper comes from in Peru and Chile, and if we add up the rest of the Americas, you'd probably end up, if you wanted to stretch all the way up to Alaska, you'd probably have about 78% of the world's copper coming from that belt. So we sit very, very well in terms of grade distribution. The Australian market also scratches their heads with the grade of these deposits. So this grade, at this scale, produces most of the quartile 1 and quartile 2 costs for global copper. And that's really important to understand. So just going on to market, and I could sit here as any CEO saying how grossly undervalued we are, and of course the share price has always got to go up because no one understands us. We like to take a very considered approach. The market gets it wrong, it gets it right, and like a broken clock is right sort of twice a day. So you will always be above a weighted average, you'll always be below an average, but very, very little of the companies actually will trade always in line with something. So this represents opportunity, and CEOs such as myself always try to point this out. The first measure we have is about how much your pounds of copper are worth in the ground. This is on a measured and indicated basis. We sit on the TSXV. We can't add up inferred and measured like we're allowed to do on the ASX. So we talk about the high quality resources that are real. And on a cents per pound basis, yes, we're trading at around four times under. Most of our peers are in North America. The investment space is obviously a little bit more au fait with large-scale copper. We also don't like to talk about the average because the average always has outliers that pull the number higher. So we trade about 4 times under on that metric, but now we're also able to talk about economics and what proportion of NPV does our market capitalisation represent. Generally in this space, you're trading between 0.2 and 0.3 at PEA or pre-feasibility level. We're trading at about 0.07, so there's a good metric there that says we're significantly undervalued. But we like to talk about the risk and the actual physicals of the project. So if we're going to compare ourselves to these really large deposits in the Americas, we like to talk about elevation because that has a direct impact on capital and direct impact on operating costs. It's why our operating cost is low. It's why our capital is half the cost of the capital required to build this scale of production. We are not in the high Andes. We don't require a $500 million water pipeline to get water up there, and we don't require a $500, $600 million water desalination plant to produce fresh water to process. We were very lucky with our metallurgy. We have slightly older deposits that do not have carbonate within the alteration suites. And because of that, we have about 2% better recoveries using salt water. So what that means is we have a very cheap project that is very low elevation, and most importantly, when we look at all of our peers, very few of them have water. And if it took Hot Chili 12 years to get our water permit licence, you can imagine the kind of timeframes that might impede some of these developers from producing some more tonnes of copper for the world. So what are we going to do with all of this treasury of $26 million that we haven't had to issue one share on behalf of our shareholders? Well, we're going to drill, and we're going to take the opportunity to finish what we started. Cannindah, the deposit sitting next to our original discovery, what has quadrupled the resource base for hot chili over the past few years. It has turned us into a near tier 1 play. But most importantly, that 600 million tonne discovery, which is slightly bigger than we knew, that Rio Tinto made at the same time, is not finished. We have a large porphyry cluster there. Drill holes will be going into the ground in a couple of weeks, and we'll be looking around our main porphyry, Cuerpo 3, and looking around a large pit scenario, which we also see for this project. Our PEA has been delivered on about 65% of our metal coming from open pits and about 35% of our metal coming from a underground below Cuerpo 3. But we also see the opportunity for a large-scale open pit, which will drive significantly more tonnes through the processing facility. So we'll be drilling those opportunities, trying to reduce strip ratio on that large open pit scenario, drilling a number of our targets within that footprint, which we started on this year, and also looking at some of our regional exploration targets. We don't like to talk too much about exploration upside at Hot Chili. We just like to get in, roll our sleeves up and do the work. And if we've got the results, then we'll start talking about it. We're pretty realists in Hot Chili. We've grown this through consolidation and deal making very methodically. And what we see here is not just the land holding that we have, the exploration targets that our very esteemed geologists in Steve Garwin that are driving our exploration approach are very excited about. That's fantastic, but we've built this through consolidation, and we'll continue to build out this area and look to own this part of the Chilean coastline. And what we want to do is create a business that is going to be there for multiple decades, is going to be producing in the first quartile, and most importantly, is going to be meaningful to the Australian market. We don't have a 100,000 tonne copper producer anymore. And if you think about that, as such a proud mining country, I think that Hot Chili's mission here is to change that and establish ourselves within the copper sector once more, which undoubtedly, alongside lithium, will be part of the two key critical metals for the future. ESG is a really strong focus for the company. I'm not really going to get on this soapbox. We have a low energy intensive footprint because we have no desalination requirements or pumping hypersalinated water back into the ocean. We can choose power providers from any one of 14 utilities on the national grid because 17 kilometres away, we're connected straight into the grid. And most importantly, the work that we've been doing in the social community has established Hot Chili as a real strong brand in Chile. We've funded a number of the orphanages in the Huasco Valley. We employ local, we buy local, and most importantly, we have Chilean nationals through board, upper management, and actually on the ground doing all of the hard work that has led to this point in time. Importantly, on the board, we've been transforming that. Most people know that we replaced our long-standing chairman who founded this company alongside of me with a very talented North American director in Dr. Nikki Adshead-Bell, who also I'm really pleased to say is also Australian. She comes from Mount Isa and she's just lived in Toronto and Vancouver for a good 25 years, but she is really driving our no dilution approach going forward into financing. And when she talks about optionality, the things that you've just seen on the financing front are just the beginning. So moving forward to a very clear roadmap. Our last resource was delivered on time within guidance. Our PEA, which we weren't expecting to put out, has been delivered on time within guidance. And ultimately, the end of this year, we'll be looking forward to the outcomes of a PEA study on a large pit scenario for Cannindah, delivering another resource upgrade that will feed into a pre-feasibility on an optimised project next year. An important mark for us next year is getting the project right, because that's the project that we submit our EIA on. And that sets a timeline to have this at financing decision in 26. And last time I looked, in terms of the copper supply and demand fundamentals, 25 and 26 is looking very, very significant for the copper price. So with that, I guess we'll see this project go into production 2028. If you were a straight line person sitting here today, how long would it take us? But we're also, we've been in the business long enough to know that perfect plans never actually eventuate that way. You can add 2 years of time frame to anyone's pathway. That is the reality of mining in this day and age. It's getting very, very hard to build a mine, and it's going to get harder. And so stakeholder management is key. It's the things that you don't see that will delay 90% of projects. So we see a 28 production timeframe, but what we can put our hand on our heart and say is this will be delivered this decade. So thank you very much. Really appreciate giving you the update.
So we're spanning the Pacific here. We've been to North America, we've been to South America, and now we come home to the mighty Mount Cannindah. Welcome. Please put your hands together for Tom Pickett for the Cannindah story.
Thanks for having me here at the Sydney Mining Club. I'm lucky last. I'll attempt to keep you awake. Look, I'm not going to stand here and say it depends on your investment appetite. Like, we're in Queensland. We don't have projects overseas. I don't run a company that's about to get into production, and I'm not going to pretend that's what we're up to. What we are up to is delineating a significant size project, and that's what we intend to push forward doing in the next short term. So this is a bit of a corporate snapshot, but the reason I include it is not because you want to see things you can look up yourself, but that graph is a correlation of the Cannindah share price in blue to the copper price in green. And if, like my esteemed colleagues here and myself, you all think that the copper price is likely to increase, certainly bodes well for the Cannindah share price, should it do so. Significant support from our major shareholder in Aquis Finance and 4J's Proprietary Limited, companies owned by Hong Kong investor Tony Fung. He remains a significant supporter of the company. ESG, as been outlined previously, is considerably important. We as explorers tend to try where possible to minimise our environmental footprint. And definitely insofar as engagement in community, etc. goes, we try and do that where possible, and also where the corporate governance is concerned and transparency. You might notice in some of our recent releases, we are very transparent in what we inform the market about. Some of them are far too long. If you could sit in the boardroom and listen to the arguments between myself and my geologist, you'd understand that. The projects themselves: Mount Cannindah, Piccadilly, Percy Marlow, Percy Windsor. Piccadilly and Percy Marlow located in North Queensland, about 100 k's to the west of Townsville. Pure gold plays. I'll go into them a little bit later. Mount Cannindah is obviously our flagship, and that's what I'll be discussing mostly in this presentation. We've completed 22 drill holes. We're about 450 metres this afternoon on the 23rd, which will be wrapped up shortly. But copper. I will talk about copper because it is supremely clear that we are nowhere near close to bringing enough production online to cover the demands if we're going to get anywhere close to satisfying the Paris Agreement and net zero by 2050. I think it was Wood Mackenzie that came out with a paper that said something in the order of $23 billion US a year for the next decade needs to be invested in copper projects. if we're going to get anywhere close to the target. And putting that in context, it's 63% higher than the yearly average for the previous 30 years. So that gives you an idea about probably why a significant amount of investment dollars is flowing from the majors in gobbling up each other, etc., but also why they're scouring the globe at the moment, looking for high-quality projects that are copper-focused, and there simply isn't enough of those either. That's off the back of basically historic lows in warehouse inventory. So when you put those together with the demand, you've only got to look around the streets and see how many kids are riding electric skateboards and electric dirt bikes, and every major car manufacturer is focusing their efforts on EV. Leave aside the green energy transition to power generation with solar and wind turbines. If you're smart, you put that where the sun is and the wind is, not where the grid is. So then you've got to put a lot of high-density copper wire to transport that energy. And you can build as many batteries as you like, but unless you can transport that electricity, then they're essentially useless. So copper is the place to be, as my colleagues have already pointed out. Where are we? We are in Australia. We are in central and north Queensland. Mount Cannindah is located 100 k's to the south of Gladstone, or 100 k's to the west of the port of Bundaberg. We have a town of Monto about 35 minutes away, and a town of Calpower within our EPM area, where we house our geological team and our drilling team. It's very handy to have that located there. We have two EPMs surrounding, I should say, 9 mining leases with a haul road going past the mine gate, and we have good access to water and power. That's a zoomed-in version of the EPM area surrounding the mining lease. There's 71.5 square kilometres surrounding 6 square kilometres of mining lease, 100% owned by Cannindah Resources. That's a zoomed-in version of the mining lease area, and that area underneath Mount Cannindah in the top left, shaded in light blue, is really where we've concentrated most of those drill holes. So it's actually quite a small area when you have a look at it from the impact in terms of size on the mining lease. The area to the right of that is Cannindah East, shaded in light blue. That's about 500 metres away. We have improved the depth extent of the Mount Cannindah breccia zone. We've improved the strike extent to the southwest, and that larger area, dotted or shaded, if you like, surrounded in a dark blue line, is the extension that we believe the Mount Cannindah breccia zone could, in a sense, be in terms of size. We're pushing towards that Mount Theodore area to the south there with drilling at the moment. There's a lot going on in here. It's definitely lending itself towards being a porphyry district. There's a lot in terms of geology going on down in other prospect areas such as Monument, United Allies and Lifesaver. There's skarn activity going on there. There's breccia from surface. There's a lot going on just within the mining lease area, but there's also good activity going on within the EPM surrounding it. This hole is hole 9. Hole 9 wasn't the one that gave me my spring in my step. Hole 3 was. We started looking at Mount Cannindah with a gold lens initially, and it wasn't until the copper price came up to, as my colleague said, somewhere in the order of 10,000 a tonne, that my interest changed to having a look at historical data in relation to copper at Mount Cannindah. And there were some good old hits. We tried to get that same zone, and the first hole hit stope within 6 metres, so unfortunately we abandoned that and we flipped around to the exact opposite direction. The second hole hit 282 metres over 1% copper, which was pretty impressive. Hole 3 was a 762 metre hole that intersected 493 metres at 1.14% copper equivalent. Now, for the previous 2 years, that was a top 10 in the world on that list. Proudly, 2 Australian companies were there, BHP and Cannindah Resources. So hole 9, which is depicted here, shows that there is a significant depth extent to the Mount Cannindah breccia. That hole was 877 metres long, and in that there was a 400 metre intersection just under 1% copper equivalent. And then we drilled across it with hole 14. hole 14 intersected 182 metres at just under 1% copper equivalent. So we're also in the process at the moment of conducting metallurgical test work. That's showing some excellent recoveries in our preliminary outcomes. We haven't got to the end of that because we keep adding things for them to look at, which require data to be tested in labs that aren't in Australia, unfortunately, so it's just adding some time. But the indications are very, very good. That's a bit of a busy slide for you, but the latest release was hole 19. So we've drilled 22 holes, about to be 23. We've released 19 holes to the market. There's a bit of news flow to come, but what that does show in the sort of 3 drill holes in the bottom section of that figure is that this mineralisation does continue to the southwest. And that's sort of like a peg leg in those 3, if you like. It's the thicker one is coming out of the page and heading further to the west and providing a far more robust nature to the understanding of what could be occurring, or what is occurring, I should say, in that southwest zone. So this is hole 9, as I said before, next to hole 11. If you aggregate the entire 877 metres of hole 9, you get just under 0.5% copper equivalent. And that was only beaten by hole 11, which was 1,100 metres long, and if you do the same thing to that, you again get just under 0.5% copper equivalent. Now, there was still some higher grade zones above 1% over 100 metres in those holes, obviously, but it does show that the mineralisation does extend at depth at the Mount Cannindah breccia zone. It's important to have target generation, and with that, we did have some previous IP, but we wanted to have a look at doing it ourselves. So we commenced an IP survey, and that goes sort of outside of the areas of interest that we have a good understanding of presently. And so we wanted to identify some areas that we could get a signature, if you like, utilising the existing understanding of the drilling, getting an IP signature that we can run around the project area and target some very interesting zones given the high quality drilling success that we've had to date. So we've only got 2 lines back, but they were announced in hole 19 that we recently put out to the ASX, and I invite you to have a look at that for yourself because it's probably difficult to see on this slide, but most of the drilling, at least in the top figure, is to the far left into a chargeability anomaly, and that's been getting some fantastic results. And then there's a chargeability anomaly off to the right, or to the east in this case, that has drilling above it, but none of that drilling hits it. So we'd like to investigate that. We've got some significant interest, if you like, in the completion of the IP survey, given the drilling success that we've had to date. Certainly exciting our geophysicists. That's some nice core from hole 19. That's exactly what you want to see coming out of the ground. Nice chalcopyrite, getting some very interesting grades out of stuff that looks like that. Every time I get my update twice a day and I see that in the photos, I get another spring in my step and we continue on. That's a pretty good example of what I was just talking about, 7.7% copper, nearly 5.5 grams per tonne gold, 140 grams per tonne silver. Really good looking stuff. Another example, 6 metres at 6.19 grams per tonne gold. There was a metre in that, 15.98 grams per tonne. That's exactly what you want to see. And we've seen that quite extensively over the drilling that we've been completing at Mount Cannindah. I mentioned Cannindah East earlier. It's 500 metres to the east of the drilling that we've been completing. We have put a hole in that recently. It's yet to be assayed and reported, but no doubt will be shortly. There has been considerable drilling in that area previously, but it was mainly vertical and mainly sub 100 metres. We did find one hole that was assayed for copper that went 27.5 metres at 1.7% copper. That hole ended at 61 metres. So there's certainly some smoke over there too, 500 metres away. I also got a water bore drilled about 2 k's from where we're drilling. And I asked the geos to have that return from the water bore analysed for copper to see if there was any anomalous copper in that. And that came back with anomalous copper as well. And I'm very interested to see whether or not that coincides with a significant IP target as well. So it's very good stuff. We're going to be getting stuck into that with some further drilling shortly. Bit of an old school method. Some people like it, some people don't, but we've done enough of it to graph it up. Instead of waiting 4 or 5 weeks for the assays to see whether or not we should keep going into a certain area, we hit it with an XRF, and you can see there that the XRF on the sludges does correlate quite well to the actual assays we receive from the lab. So it's a very helpful tool for us to make decisions on the run, so to speak. We're only waiting 2 days instead of sometimes 4 to 5 weeks. Turning now to Piccadilly. Piccadilly's, as I said, pure gold play in the well-endowed gold region of Charters Towers. That's one mining lease surrounded by a number of EPM areas heading down towards Charters Towers there. We have drilled 31 RC holes, all of them returned gold results in the Piccadilly in the mining lease area. It's an intrusive related gold system target. These typically occur in clusters. This is why our geologists had an interest in those areas to the south. There was some historical drill hits there, over 100 grams per tonne gold over a couple of metres. That was certainly worthy of follow-up, and we'll be applying a bunch of the information that we've and data that we've analysed over Piccadilly to those areas to the south shortly. That's a bit of a match head size bit of gold that you'd like to see in quartz veining, and that's from Piccadilly. It's great to see that sort of stuff. You want to see more of it if you can in the drilling results. But that's certainly stuff that we have been seeing at surface at Piccadilly. Some of the rock chip sampling there went above 80 grams, which is great to see. Certainly more work to be done in terms of drilling that prospect area out. So the future looks bright in terms of Cannindah. We've continually to expand upon size. We really want to identify the likely porphyry feeder. So it's either that there's a bunch of these prospect areas. I should mention that hole 3 got those results from surface. So you want to get a bunch of those higher grade zones sitting above a massive porphyry feeder, which is what we're trying to identify here. We've identified that the majors are spending a significant amount of money looking around the globe for copper projects. If you can delineate a significant porphyry, low-grade, high-tonnage proposition, somewhere in the order of 0.3 to 0.5, and you identify enough of it to generate 100 million tonnes, 200 million tonnes, these guys are going to come hunting you. They've got no choice. There's not enough copper around, and we've got a lot of work to do if we're going to get anywhere near the 2050 targets. So we've got excellent relationships with our major shareholders, excellent relationships with landowners. We employ some of them. We've got, as we said, huge demand for the critical metals we're looking for, and we've got no debt. So I really appreciate your time listening to me. If you want to have a chat, let's have a chat after.
Three great copper stories. I'm always amazed at the power of the competence of Australian entrepreneurs, CEOs, managers, exploration geologists, and what we do. And look at us working on 3 different continents here and doing great work finding the copper for the future. It's the best thing you can do is send to for any country in the way of aid is sending an Australian company there to do something like equivalent to this sort of work. It's just fantastic what wealth we generate in faraway places. So I was humbled by it. We've got time for questions, and probably a roving mic too, I imagine, somewhere. Yeah, Simon's got it over there. If anybody would like to kick off, yeah, we've got one down here. We've got
To the first gentleman, I noticed part of your slide you have Glencore has 7.5% of your share register. You mentioned in the slide that was it Glencore was for you? Sorry.
Yep.
Would they Glencore be buying that at market, or do they get some sort of discount at that? So what is the advantage of the company in Glencore having access for the first 8 years to a certain percentage of your mineral?
Yeah, you want to jump up here and answer that? Yeah.
Thanks. Good question. So I guess we were quite flattered with Glencore's interest in the company, and fantastic to have, I think, the second or third largest producer in the world. It depends which month you're talking about. They either are the second or third largest above BHP, underneath Codelco. So to have them invest in the project was, first and foremost, it was a great vote of confidence. The agreement on offtake, generally with a Glencore investment, and I guess that was what really differentiated this, was an offtake agreement that comes with that investment. We said no. So we went from bringing them on as a 9.9% shareholder, putting the head of their global copper group, Mark Jameson, onto our board, creating a steering committee to help guide the project through to production. And we were happy to negotiate an offtake with them in time, but only if it was for benchmark pricing, which is very transparent for us and for everyone else in the industry. About 60% of the world's copper is sold at benchmark terms every year. And we were happy to have that as a hedge on copper, with the largest copper trader in the world handling 52% of the global book. We have a very high premium product on our concentrate. It's one of the few new concentrates that will be coming that is almost devoid of arsenic. And so that represented a huge optionality for Glencore. They blend these products to produce fit-for-purpose concentrates into the Asian seaboard market, and ultimately that was a win for Hot Chili. It was a win for Glencore. But we were certainly not going to be giving up our offtake rights on 40% of the product within the first years. That's about our optionality for funding, so that we have further non-dilutive options up our sleeve before we get to financing. And secondly, we didn't want the project encumbered after year 8. Everything within the first 8 years was really critical for us to have stability on our revenue. But after that, we think that the project will be well and truly on its feet, and well and truly starting to hit the kind of significance that, at this point in time, Costa Fuego represents the 29th largest mine in the world if it was in production. By the time we finish, we want to have this approaching the 20th largest mine in the world. And so when you have that amount of offtake and you're talking about multi-decade projects, it's important to keep the offtake agreement alive with Hot Chili. And the fact that Glencore did that deal was very unique. It's not a deal that Glencore has ever done previously, and I don't think they've done it post this deal. And the second aspect of that was a really important commercial point that was about the alignment of the two companies and their shareholding, that they're not allowed to drop below 7.5% in Hot Chili at any time, which if they do, then they lose their director and they lose all offtake rights. So from a competitive tension perspective, the company has maintained that. We have a significant amount of interest from most of the large-scale copper producers in the world that are watching the project develop. But everyone understands compulsory acquisitions in Australia and the 90% threshold that exists. If there was ever a move on Hot Chili to take us over, whoever gets to 90% removes the offtake, unless, of course, it's Glencore. So some important points on the Glencore agreement with Hot Chili. Thanks.
There you go. Plenty of answer there. Very good. any other questions? We have run a little bit over time, but we do have time for if we got this one down the back, Finola. And if you got it, if anyone else has got a quick one, we'll field that. Otherwise, we have some special gifts for you guys for all your efforts. But we'll take Finola.
I'll try and be quick. Mike, we've seen both Rio and BHP hit roadblocks with their project in the US. Where do you sit in terms of public land for your project? Is it bordering? Is there any sort of issues there when you come to getting approvals?
Yeah, great question, and I appreciate the opportunity to answer that. You're probably referring to the development or the proposed development of the Resolution copper deposit, which BHP and Rio jointly own. We're looking at two completely different scales of operation. So Rio and BHP's proposed project will move in 13 days they'll move 100,000 tonnes a day. So in 13 days, they will move what we propose mining in a year. So it's drastically different scale operation. The extent of their footprint, their infrastructure extends, and it's not comprehensive across that area, but the extent of their infrastructure is 30 kilometres one way by 50 kilometres another way. And they're down around population centres and really mixed land use types, including mixed ownership. On the flip side, as I say, our project is moving considerably less tonnes, and entirely our disturbances are going to be on privately owned land. And with privately owned land, then we are answerable primarily only to the state of Arizona. And I think I mentioned that in the state of Arizona, mining permits are approved in 15 months, or by default you're awarded those permits. Now, we will need to get a federal permit, we expect that we'll need a federal permit, but that federal permit is simply to use an existing road that crosses some federal land to bring consumables and people in and concentrates out. And so we're going to propose burying a water pipeline along that, which is potable water. So that is the extent of our impact on federal land. For the remainder of our permitting, it's going to be state permitting, which is a very streamlined process.
Great. Well, I'm going to bring it to stumps right there. Listen, courtesy of us, you do get a streaming version of your presentations. Linda will hook you up with that, and you can get. It's handy for your website, or if you want to keep retelling that story in digital form. This is a pretty special gift that we put together here. It's an actual replica of the Eureka flag made in very modern, last forever flag material, stitched and sewn, and it is a. I'll just show you there it goes. The beautiful Eureka flag. It is a reminder. It is the people's flag. It's not the CFMEU's flag. It's a reminder to in our view, it's a reminder to governments that they should never get heavy-handed with the industry. The industry is where remember on the goldfields there were people there risking life and limb and working very hard, and they were harassed and ultimately killed by their own government. And it's they don't kill us anymore, but they've got some other very interesting tortures that they bestow on us regularly. And this is a reminder. You can fly it with pride. It doesn't conflate with the rebel flag of America. It is Australia's own flag for its own reason, and it is. If you'd just like to come up and. On behalf of the members, I'll give you these gifts to thank you for your presentations tonight.
Thank you very much.
Yeah, enjoy that. Treasure that. Real thing. Good on you.
Thank you.
All right, well, we'll see you back again next month. Not sure who's on next month, but it's a lunch event back here again, middle of the day in a month's time. So thanks for coming.